You make money from the stock market either through capital appreciation or through earning dividends. Now, if you lean more towards dividend payments, today we are going to show you 5 stocks that have paid dividends consistently in the stock market. Yes, especially for those who appreciate more of dividend stocks. Now, you already know this is clockwise, and you already also know my name is Providence. And you also know that I'll not be doing this alone. Now, my stock market analyst is here. You know what to do. With a resounding virtual round of applause, welcome, Mr. Canel. Welcome to Clockwise.
Thank you very much.
It's actually nice having you again. Always having you again. Yes, always having you again. Now, today we are discussing something very, very interesting, especially to dividends stock portfolio owners. Now, you see, many stocks actually pay dividends. Some pay differently. Some pay at different times. First, let's understand what dividends payment is and why do some companies pay and some don't pay.
Okay, thank you very much. So, dividend payment is when a company earns a profit, a decent profit, they decide they can use that profit in 2 ways. They can, on 3 ways. They can do share buyback, so they buy back their shares from shareholders. Number 2, they can actually use to reinvest in expanding the business. They can also use, in fact, they can even use to pay off debt. They can also use that. There are several things, but one of them is they can use to pay dividends to investors. So companies do this to ensure, to reward investors. So dividend is a way of rewarding investors for being loyal to the company, for providing capital for the company to use for its business. So companies pay dividends, like I already said, from profits. Yes. So when a company announces profits and then pays dividends, then that is a good company. Some companies actually pay dividends even when they don't have profits. So that is something that I always look at as a red flag.
Okay. Once they pay dividends and have not made profits.
Yes. So retained earnings are supposed to be used to pay dividends. But when you see some companies that will pay from what they already have, which is that company is trying to mask the maybe some of the challenges they are facing, just to be able to continue to sustain shareholder interest.
So that's a wrong.
That for me is a red flag, because you are supposed to pay from what you are making.
So you don't just, so as an investor, you don't just focus on dividends. Also focus if the company is actually making
profit. So if a company comes in and announces interim dividend, for example, we are within the period of half year H1 announcement, half year announcement, and then the company is telling you they actually wound up in a loss, and then they are still going ahead to pay dividends. Then that should tell you that they are paying the. Where are you getting money to pay dividends? Are you getting from what you should be using to expand the business, what you should use to increase your competitive advantage or your moat to be able to make real cash? So that for me is a red flag, really. So companies pay dividends to reward shareholders based on the profit they have made.
So they're supposed to pay dividends from
the profits they have made. So that the shareholders will at least be rewarded. Remember, a shareholder gives cash, puts his money down for you to use and make money, and then you have nothing to do.
Okay, now talking about dividends and the season that we are now, we've seen BOA. The latest is just BOA. When BOA releases its own dividend report, we saw 1 naira 30 kobo. Yes, and people like, where are they running to? What do you have to say about their report?
No, so here is the deal. There's something we call dividend yield. So you don't just look at dividend, you look at dividend yield. That's why, so you look at what is the price of the share? What is the price? A company that is doing 125 naira, for instance, and is paying 5 naira dividend yield, and a company that is doing 20 naira and is paying 1 naira dividend yield, I will buy the company that is 20 naira and 1 naira dividend yield. Especially if I look at the earnings, the PE ratio. And the reason is because now, so let's do it this way. I'm buying that company, the other company, 125 naira minus 5 naira is 120. This is 19. So I'm paying more to hold that other company. Do you understand? So you realize that, and especially if the company, if the 20 naira company is on that, that's why it is one of the reasons why I told you. Let me give you something to think about. Access Bank is trading at, I'm just trying to give you an analogy so you understand how we look at some of these things. Access Bank is trading at 27 naira now. If Access Bank pays 1 naira dividend, it will be equivalent to Zenith Bank paying 19 naira dividend. Yes. Yeah. So you realize that you don't just look at the dividend itself, what you are getting, but what you are looking at. That's why you saw, even when Aradel announced the dividend which they announced, the dividend push up to 125. Sorry, the earnings push up to 125, and then but the dividend still stuck at below 13 naira. Investors were not happy because when you look at 25 naira and then you look at the company trading at 1,700, it doesn't really cut it. So you have to look at dividend yield, not just the dividend itself.
Okay, all right. Now let's look at those 5 companies actually that will be paying dividends consistently. And they will also pay that the investors can take advantage of.
So in this list I'm going to give, it's not just companies that are paying dividends that have been paying dividends. I'm going to mix it with companies that have been paying dividends, companies that I believe things have turned around to get them to be paying dividends sustainably. Okay. There are some headwinds because the reality is that if you look at some companies, there are some companies that have been paying dividends for some time, but they had to stop because of some very serious macroeconomic headwinds. Yeah. I had to make them to stop, and then they are now resuming dividend payment. Let me give you some. Let me give you a name, for instance. You look at Guinness. Guinness has been paying dividends. But when that FX challenge happened,
they actually stopped.
They actually had to stop because they were racking in losses, given the fact that they're very import dependent. And then when you have FX volatility, they racked up so much losses. We have other names that actually suffered very seriously. Even the likes of Access Bank, UBA has been paying dividends. But because of the payment charge and all of those things, the challenges they had, they did not announce dividend for last year. Even First Holdco, we saw what happened. Access Bank, we saw what happened. When the tide turns and then those headwinds disappear, that's why I believe that if not for this year, next year, Access Bank should be able to pay dividends. Yes. I believe that. If not for this year, I'm not really hoping for this year. It's not impossible for them to pay this year. But I'm also looking at the fact that they have a lot of things. They have this First Holdco, this Holdco thing, regulatory framework would need them to raise about over 600 billion. So a way of doing that would be from retained earnings. That's number one. Number two, the impairment charge. So they are still not Huru yet. So they could want to just keep some cash so that they can account for all of those. So beyond that, if those things disappear, are addressed, then I don't see the reason why Access Bank should not start paying dividends. So that is what actually keeps companies from paying dividends. When headwinds come in, they won't. They might not be able to pay dividends. So we have heard calls. The first name I'm going to mention, if you want to build a dividend stock portfolio, one of the names that is coming, and I believe will continue to pay dividend for some time, is NGX.
Okay.
NGX, the company. And the reason is because, apart from the fact that they made an insane 118% year on year in terms of their top line, I think we have seen a lot of turnaround. Remember, the NGX actually makes money from what? From trading. From whenever you place trade and I place trade, they actually make money. Profit before tax actually rose by 170%. And they have already, I think they have declared dividend per share of about 1 naira 30 kobo. So, but that's not a once. I don't rely so much on one time. I ask myself, what will make NGX to continue to remember? Their margins are very wide because it's not asset intensive. They are facilitated. They don't have to produce. They don't have to produce to be able to sell. No, it's more like a build once, sell forever kind of thing. So for me, what are the tailwinds that makes me believe that NGX is going to continue to be successful in terms of paying dividends? It's because the reason for I expect them to maintain a decent revenue growth or earnings growth going forward, because the number of retail and institutional investors in Nigeria is getting wider and wider, and we are seeing some glimmer of hope, some silver lining. You have the FTSE Russell, you have the S&P Global, and then the Dangote listing that will push the All-Share Index, the market capitalization of the Nigerian market to way past $200 billion dollars, making it come within the radar of some high volume, institutional investors and sovereign wealth funds, as well as foreign portfolio managers. So that all of these show that we are expecting to have higher trade volumes, deeper market liquidity, and all of that. And then apart from that, there is also the new rule about 20% float. If a company does 20% float, look at the likes of most of the companies you see. Some of them are 5%, some of them are 10%. Dangote is coming to think of listing just 10%. 10%. Imagine Dangote does 20%. That is, so 10% is already $5 billion. 10% is about 10% is already $5 billion. 20% will be $10 billion. Imagine adding that kind of liquidity to the market. So you realize that with all of this, with more of this, with more gigantic listings happening, that's a tailwind for the NGX. So I think NGX is going to do well. I think it deserves a place in your dividend stock portfolio. Okay. The other name I will mention among the companies that have done their H1 results, I'm also interested in a name called United Capital. Okay. Yes, United Capital, because though the dividend per share is not that much, I would say. I will tell you if I want, this should come into your what we call watch list. And the reason is because there are contenders. Remember, we were talking about the top 5. There are contenders. In terms of dividend yield, there might be better contenders. But I mean, this one is also a name that you should look at. Profit after tax grew by some 7%. And I told you that that is what actually fuels earnings. Dividend payments. Yeah. So if this continues, then United Capital should be a name that you should watch, and possibly add to your dividend portfolio if you are able to expand it. United Capital. So the next one I would also mention, which of course there is no way you can ignore it in terms of dividend history, excellent. In terms of even dividend yield, excellent. By the way, this is the name that pays out over 70% of its profit to investors. Okay. That name is Dangote Cement. Dangote Cement. There is no dividend. You cannot build a dividend portfolio of Nigerian stocks without adding Dangote. You can
call them the king of dividends payments.
Yes. There's no way you will not without adding Dangote Cement. It's not only because it's the largest company by market cap of the NGX, but it has one of the longest and unbroken history of dividend payments. They do interim, final dividend, literally consistently, all the time. So, of course, this year cannot be a different one. So, and apart from this, I'm interested in Dangote, and one of the reasons why I will even bring Dangote to the top is because you are not just earning dividends, you are also earning return on equity. Dangote has posted some of the best returns on equity you can think of.
And they are still expanding.
Meaning it's still we are
expecting stay between the growth and the dividend.
And then the fact that they have the kind of cash flow they have means we are operating in a high interest rate environment. So the fact that they have so much in cash means that the likelihood that they are going to suffer a lot of they will go to the market to borrow money and suffer a lot of interest charge is very low. Because one of the things that that affect companies, that you could see their profit before tax, you see their profit, but when you now begin to remove some of those, you look at their EBITDA, it's very excellent number, but when you begin to remove those interest payments and all of those things, and then debt servicing, you now realize that the numbers become very poor. So, but Dangote doesn't sit in that. Dangote Cement doesn't sit in that circle. It has an excellent cash flow. It has, his balance sheet is insane. Of course, if you look at the balance sheet, you look at the income statement, you look at the cash flow. It's actually very robust. So it deserves a place in your portfolio. In fact, if you ask me, there are two names that you cannot remove from your portfolio if you are looking at interest payments. Dividend payments and return on equity.
That is NGX.
That is that is Dangote Cement and MTN.
Okay, yeah.
And MTN.
It's true, MTN.
Yes. So, but in the
NGX should join.
NGX would join, but you cannot. Let me tell you, if I'm to put up, let me be very honest with you. If I'm to put up 5 names, I didn't want to do it at this point, but if I'm to put up 5 names, I'm going to tell you those 5 names I will put up. But I'm trying to look at all of this one because I'm also looking at the new names, the new guys that are coming in. Okay. Because I'm not only looking at dividend yield, I'm also dividend history entirely, but I'm also looking at, can you kill 2 birds with 1 stone?
Dividend.
You know, when these names begin to pay dividend consistently, investors will throng in, and then the share price will appreciate. But so there are some names that are still coming up. Because the headwinds that actually stop them from paying dividend have kind of cleared a little bit, and so they have had history. For example, this United Capital, they've had some history of payments. They maybe for some reasons they are not able to continue. Maybe they had some interruptions, but they can continue if those headwinds disappear. I just give you an example of some of the banks. So we have NGX. That one should be on your portfolio. You should have the United Capital should be on the watch list. It could actually get into your portfolio too.
Dangote Cement.
But that's if you have more. But because we are talking about the top 5, you could put United Capital on your watch list. Then the second one would be Dangote Cement. Yeah. The third one would be MTN Nigeria. MTN Nigeria because number one, MTN is a behemoth. We've seen what Airtel has done. Airtel's numbers, you couldn't have looked for a better earnings score. You couldn't have looked for a better earnings score. In fact, decent in every parameter. That's what investors are looking for. That's what investors are looking for. So if Airtel can do that, and by the way, just remember that MTN has more, in terms of market penetration, MTN has larger than Airtel. If Airtel could do that, that's why when we talked about undervalued stocks, I said I believe MTN is undervalued, very undervalued. Forget about the fact that MTN is trading at 12 times earnings, but the likes of with the kind of potential MTN has, MTN should be trading at north of 18 times earnings. Okay. And you might be surprised that MTN could give us a report that will be so good that the earnings multiple will collapse. That's if price does not shoot up, the share price does not shoot up astronomically, then the earnings multiple will collapse. If the earnings multiple collapse, that means you are even getting more earnings for your money. Yeah. So MTN is there. I believe, we know why MTN for some time did not pay because, they were suffering from very serious FX volatility. They were racking in a lot of losses because of the FX volatility. But MTN comes in very prominently. Then, of course, the behemoth, the banks, the 2 banks that you must always, Zenith Bank and GTCO. Zenith Bank and GTCO for me is, Zenith Bank, it represents not just a dividend play, but also a growth play. If you're looking at dividends, if you want to catch both dividends yield and return on equity, then you want to look at Zenith Bank. Remember, Zenith Bank is loved so much by international institutional investors, because number one, it's very liquid. Number two, it is the balance sheet discipline is unrivaled. So, the chances of the banks having cracks is very low. International institutional investors want I mean, there is geopolitical risk everywhere.
Yeah.
So the name that would reduce that risk is a name that is very, very, it has what we call a fortress balance sheet. You don't want something that is shaky, because once it's shaky, the chances of you being able to exit that name is very, very, it would be very slim. So institutional investors love Zenith Bank. Then when it comes to GTCO, of course, you know that GTCO is it's a darling to many people. Yeah. For starters, GTCO has, when we talk about ability to use cash, GTCO doesn't have so much in terms of cash to deploy. But you see the little that compared to the likes of Access Bank, compared to the likes of even Zenith Bank, but you see what they have, they are able to deploy it so masterfully that the kind of return on equity they give to investors is massive. And then also dividends, you are very sure, or there's a very high likelihood you are going to get dividend from GTCO. So, and of course, GTCO, when you talk about the digital space, when you talk about penetration,
the Gen Z,
the Gen Z, they have actually captured that market. Yeah. And then
they are competing well even with fintech.
They are of course, they are competing very well. GTCO, like I told you, is the only bank that you can walk in and get your USD in cash. In fact, I told you the last time that even Bamboo recommend that people should not pay into their, if you want to deposit into Bamboo, you not pay into their GT domiciliary account. That shows you how a particular name can, because I mean they have foreign subsidiaries that actually help them to get access to this FX. So the bank with the best FX liquidity in Nigeria is GTCO, and I think that actually gives them that competitive mode. So with that, you are looking at banks that are able to have very decent bottom lines. Because with decent bottom lines, they are able to pay dividend and pay dividend consistently. When that happens, then you have investors will always reward those institutions. We have seen a number of names. We've seen some companies that have done their half-year result. Some of them have indicated losses. Some of them have indicated tiny to zero profit, but and then you've seen what the investors have done. Because again, nobody will want to give you money. You are not a good steward of people's money if you are not able to use that money and make something decent. Okay, good. So for me, if I want to set up a dividend stock portfolio, here is what I'm going to do. I'll do Dangote Cement first.
MTN.
I'll do MTN. I'll do NGX, because I know what is coming in. I'll do GTCO.
Okay.
I'll do Zenith.
That's 5.
Then 5. If I have some spare cash, I'll do the likes of United Capital. Unilever, you saw the results that they brought in. Unilever has come onto my radar very, very seriously. The return on equity was so good. The earnings growth was good. And then I think it will come in. In fact, Unilever for me would be not just a dividend play, but also it would also be a defensive for me. Okay. Because Unilever, they do a lot of the products that you have, some of the consumables that you use. And what that means is that, because I am, in as much as I'm pursuing dividend yield, I'm also having a very serious challenge with the fact that the way the oil prices are going so high these days, I am very skeptical. I'm very skeptical that inflation will take down. If inflation does not take down, then I'm not sure Cardoso and his team will even consider lowering rates at all. In fact, you might even see rate hike come back to the table. And that would actually push up the bond yields. It pushes up bond yields. Everybody will rush to that, the fixed income market. And that would, what happened the last time it ticked up? The last time the yield almost got to 19%. You saw what happened to the equity market. Yeah. It took a plunge. That could be an opportunity. That such dislocation could be an opportunity, but again, it might not be the best use of capital. Because you look at if I've invested for 6 months, and then the return on capital is not, or return on equity is not as comparable because of the macro, the headwinds within the equity space, maybe I could have made more money if I deployed it to fixed income.
Yeah.
So that's why I'm saying, I in everything I keep on saying here, I try to put in defensives. Unilever could be one of them, a defensive. Nestle could be one of those defensives.
Yeah.
So always trickling maybe 2 defensives. If you are building a portfolio, try in a high interest rate environment, always put in 2 defensives so that you know that whatever happens.
Now, finally, before we go, there are people, there are investors that are more interested in dividend payments. They're very, very interested in it. They actually go looking for companies that pay dividends. Now, if you were to actually advise them, what are the indices should they look out for before investing in a company they know will pay dividends?
Dividend yield.
For how long?
5 years.
Okay, if they've paid consistently for 5 years.
Yes. If for any reason they did not pay, ask the question, why did they not pay? For example, I just mentioned MTN, and I know why they did not pay.
Okay.
Because it was a temporary setback. So, but if it is a company that pays this year, skips it and pays, if that means the business case, the business case is not really a lucrative one. It's not making so much money.
Okay.
Yeah. So history, though past performance is not a guarantee for future return, but it also allows you to project.
There should be a reason why they're not paying.
There should be a reason why they're not paying. Otherwise, it's not a name. So you look at that. Then another thing, while you are looking for dividends, let me tell you something. I've always said, look for dividends, but also consider return on equity. Okay. Let me tell you why. If I buy a company 100 naira, that company pays me 20. I buy a company that sits for 1 year and moves from 100 naira to maybe 120 naira, 120 naira. Then pays me a dividend of, say, 10 naira, for instance. I'm just trying to be very extreme in the dividend yield. Then, do you know what that just gave to me? 130 naira. Okay. Let's be honest. That is a 30% return on my investment. Another company is selling for 50 naira. And 50 naira pays a dividend of just 5 naira. But within that period, it has moved from that 50 naira to 80 naira. That is 80 naira, or that is 30 naira plus 5 naira. That is 35 naira over, that is already 70% return on investment. So you realize that it is a total return, not just dividend. The other guy paid 10 naira dividend, he paid like twice the dividends of this guy. But you see, the return on investment was just 30%. But this one paid half.
But the return on investment was 70%.
Even if it pays, let me even tell you, you might say, okay, it's almost the same thing since it's paid. The other one is paying 10%, because 10. But even if it pays 2 naira, even if it pays 1 naira, you are talking about at least 50 to 60% return on investment. Yeah. Because of the share price appreciation. There are some companies that they pull everything they make to pay out shareholders, almost everything, so that the shareholders will be impressed. Whereas no expansion, and so the return on equity is tied. So when you look at your total return, which is share price appreciation plus dividends, and if there is even a bonus share, you add everything together, then you now look at your absolute return. Sometimes the companies that pay fat dividends don't deliver the best return absolutely. So you have to look at all of those parameters before you make it.
You've done justice to it. Thank you very much for coming. Thank you. I will keep an eye on those. You said what United Capital. Yeah, it will be on the watch list. Thank you very much for coming. Now, on that note, we've come to the end of today's episode of Clockwise. Do not forget to like, subscribe, and also share or put a notification bell on this channel because of the content we bring. Now, if you want to join our community, if you go to our profile page, you will see a profile link to our Telegram community. You can use that to actually come to our community, or you go to Telegram directly and type Clockwise Podcast, and it will lead you straight to our community where we share real-time information. Now, my name is Providence, and I'll see you again.